to go up, and what's driving that are services and housing. Housing eventually, services still has some price increases to process from wage gains.
Jason, how about, I liked in the notes, I think you called it inertial inflation here, and maybe it's even poised to go higher given we haven't seen the full effects of anything.
Yeah, look, a lot of these releases surprised us. Maybe this will. But my worry is, yes, this will be good for consumers in the short run, but the parts of inflation that are most sticky, that last the longest, that are the hardest to get rid of, those are the parts that have been rising lately. I'm worried we'll see more of that in this release.
Ahead of the release, we are seeing futures creep a little bit higher. Seema, I'm wondering how you are positioned for this and what you anticipate.
So I think, look, we've seen over the last couple of inflation readings that they can go very much against what markets are expecting. I think going into this, and given that we have a lot of momentum, positive sentiment in the market at the moment, that it's the right time to be neutral equities. That doesn't mean that I'm neutral for the next 6 or 7 months. I think there will be renewed equity market downturns. But for now, I think it's time to be neutral.
Stephanie, what is good news out of the release in your view? Is this the weird good news is bad news is good news sort of a world that we live in?
No. I think good news is good news, and good news would be that the number comes down substantially. Obviously, we're looking at the year-over-year number, but the Fed looks at the month-over-month number. That number is expected to be two tenths in terms of the headline, and then 5/10 on the core. So, to the extent we can see some of the month-over-month numbers come down, that would be viewed positively. But we're going to need to see many months of month-over-month declines for the Fed to take a pause.
Okay, numbers have hit. Rick Santelli, what do you have?
On the headline, expected up 0.2% for our consumer price index July read, unchanged, double goose eggs, 0. And last month, of course, up 1.3. That's the highest level since 2005. If we look at ex-food and energy, up 0.3, also less than the half of 1% anticipated, and less than half for the rearview mirror, which was up 0.7. The high water mark here, folks, goes all the way back to April of 2021 when it was up 0.9%. Now, the year-over-year numbers. Year-over-year headline up 8.5. This is the one I was a bit nervous about. In the rearview mirror, it was up 9.1. That was the highest since 1981. 8.5 brings us back to levels we haven't seen since just April of this year. And finally, ex-food and energy on the year-over-year outlook, up 5.9, expected to be up 6.1. It equals our last look, which was up 5.9. High water mark here was in March, where it was up 6.5, the highest since 1982. And if we look at what's going on with interest rates, they are falling. And for a change, we have a bull steepening going on. Bull steepening, meaning prices are rising, and that's pushing short rates down almost twice as fast as long rates, but all rates are going down. We're down almost 16 basis points in a 2-year. We're down about 10 basis points in a 10-year, and it underscores the Fed, by its very nature of ill forecasting success, is reactionary. The market's not, and the market continues to do what it's now done for weeks and weeks, and that is long rates are moving down. It believes that transient ultimately will be the correct word. The problem was the time frame. Melissa Lee, back to you.
What a rundown, Rick. Thank you. In a nutshell, cooler than expected across the board versus consensus estimates, which seems to lend some credence to the notion that the Fed could pause. We're seeing futures rise very sharply. Rick had mentioned the sharp decline we're seeing in 2s and 10s. We're seeing a sharp surge in the futures. Right now in the Nasdaq, we're looking at about 320. S&P looking to be up by about 72.5, and the Dow is looking to add more than 400 points. Steve, what's your initial reaction here?
We did get the pop in services that I was concerned about. The owner's equivalent rent, which is the proxy for housing costs, rose actually more than expected, up 0.7%. Services less energy, up 0.7%. That's a big part of the index, both of those things, and they're rising relatively quickly. It looks like there was a little bit more fall off in the energy prices. I'm not sure why we didn't get the services pop. I think you're right, though. I think the market is right. This means quick reaction. I'm not sure the Fed can do 50 on the back of this. I think they still might do 75, but it could suggest some attenuated rate increases down the road. Jason Furman has an interesting piece with which I somewhat disagree about his concern about productivity from yesterday's numbers. And that's going to be also important for the Federal Reserve. It's a bit of a wonky conversation, but it's very central to how we live our lives.
Yeah, Jason, I don't know if you want to respond to Steve before we get to Victoria here to get her take, but the next Fed meeting is a whiles away at this point, right? I mean, it's the end of September.
Really good point.
So
Couple
there's
data.
quite a bit that can happen between now and then. But for now, it looks like things are cooling. Maybe the Fed can sort of take its foot off the gas, so to speak.
Yeah, look, this is a much better report than I expected. Seeing a headline number of 0.0 is exciting. There's more reductions in gasoline that we're going to see when we eventually get the August CPI too. I'm much more focused always on the core CPI. That coming in at 0.3, that's the lowest we've seen since September of last year. Some of those inertial components we were talking about, like owner's equivalent rent and rent, those may have been higher than expected, but they did tick down a tenth, both of them. I thought that was good news. And by the way, goods prices were still up. Those could easily be flat or start falling at some point, providing some additional relief. So I never try to take in too much from 1 month's data. For the last 3 months, the core CPI is still running at an annual rate of 6.8%. This could easily be like the false dawn that we saw in September 2021. But for now, I'll take it as a tick in the good direction.
For now, Victoria, could this mean an extension of the run that we've seen broadly in equities since June lows?
It might mean that, Melissa, but I actually am going to be curious to see how the markets play this out for the rest of the day. Obviously, we see this knee-jerk reaction in the futures, but when we look at what really matters for the Fed, as we've been saying this morning, it's that core number. And year over year, that did not come down for core CPI. And the Fed has consistently talked about wanting to see that core number, the month over month and the year over year, come down. So I actually don't think that the Fed's going to look at this and say, okay, great, we can take our foot off the gas. We can slow down a little bit here. I don't think they're ready to make that decision yet. As you mentioned, there is a lot of data left before the next meeting. The next CPI number, I think, is actually going to be even more important because it's going to tell us, are we actually going to start establishing a trend, even though 2 months doesn't really make a trend, but are we going to start establishing that? Or was this just more of a one-off and we're starting to level off and we're going to stay right around where we are, because it's that sticky component of inflation.
Hey, good people. Hey, sorry I can't show my face right now. I had I was off by an hour on my time and I found out I had 3 minutes. So trust me, y'all don't want to see me. Hey, someone said this is the bull market continues. Me personally, I don't think we're in a bull market. We're not in a bull market. We're just having a bounce. And just remember what I said months ago. Literally, I think a lot more than 70% of the times, I think it's more like 80% of the times, we do have a bounce before a true recession hits. After the 2- and 10-year yield curves invert, which is a sign that we're going to go into a recession, we have these bounces. And what happens is a lot of people think we're in a bull market. We're going to avoid a recession, and then they go all in. But, I would strongly suggest against going all in at this point. And you do what's best for you. Remember, anything I say is not a suggestion for you to buy, hold, or sell. But I am being cautious. I also have a portfolio where I'm in my Moomoo, which there's a link below. That's where I'm putting stuff like gold, metals, and energy, anti-recession, a hedge against recession plays that will do well. Okay, good people. Yeah, this is just a bounce. It's people are getting, excited about a few green days. And I'm just suggesting, I can't tell you what to do. I'm just suggesting that you don't get overzealous, but continue to dollar cost average, because all of the DCAing we've been doing, so we are buying, but we're DCAing. All of the DCAing we've been doing is paying off. And if the market does take a turn and go for the worse, that means that we're simply getting things for the best price. All right, good people. I will be back later today. We'll discuss these CPI numbers. We'll discuss everything. And remember, the market kind of reacts green, finds what it needs to do, and then does that over the next 2 days. So let's see what the market does. I'm going to get some coffee and take my voice out of the basement. I love you guys. We will see you later. Live, love, laugh, and learn.